4 external members who would have views which they would express publicly, we thought would lead to more activism. And I think that is absolutely how things have turned out. So the fact that there was a clearly defined inflation target, symmetric, set by the Chancellor, with a structure which encouraged activism, both raising rates and lowering rates, I think that is at the heart of why, in monetary policy terms, things have succeeded. And then the final thing I would say, because you asked me a rather big question, the big change which then happened after 2010 was the introduction of the Financial Policy Committee, the change in the nature of the bank's responsibility for macro-prudential, but also micro-potential leadership. And there, I think, it's more challenging. We have a much shorter track record than on monetary policy. I think the jury is still out as to whether this has worked. I hope it does. But clearly, the target is much less clearly specified. There isn't an obvious symmetry. And we haven't seen the kind of open debate and an expression of view in the FPC that we've seen in the MPC. And so I think those are issues which are still a matter of concern. Okay. On the monetary policy side, it's worked, and we are where we started 25 years ago.
Really good overview. Mr. Osborne, would you like to comment on that? Looking back, how do you think operational independence has worked?
No, I broadly agree with Ed, which I'm finding I do more these days than I used to. And there was never any kind of question in my mind when I came into office in 2010 that I would substantially change, or in fact change in any way, the monetary policy arrangements. We made substantial changes, which I'm sure you're going to come on to, as Ed alluded to financial supervision and macroprudential measures. But I stuck with the remit and the approach to monetary policy. I would say one thing, and Lord King is here, and he was the governor at the time. I did think there was a responsibility amongst the principals to make this arrangement work. I think there's a real responsibility for the governor of the bank, the Chancellor of the Exchequer, the Prime Minister in particular, to make these arrangements work. So you can prescribe in legislation all sorts of frameworks, but if the individuals concerned don't want to make it work, then you are going to start kind of grinding through the gears of the British Constitution. And I think you saw that last autumn in Britain when you had a Conservative government that did not particularly value the then Governor of the Bank of England, made no secret of it, and ended up heavily depending on the Bank of England in a crisis that they had created. So when I became Chancellor in 2010, my number one priority was actually to establish a good working relationship with Mervyn King and make sure that not only would we have a kind of formal relationship in terms of exchanging letters and the like, but that we could have a proper informal partnership which didn't in any way compromise his independence, but enabled us to both fulfill our functions of trying to make sure the British economy was a stable and prosperous place.
Can I just ask you, just before I turn it to Lord Davis, just in terms of that relationship, which is very interesting, and both of you, and obviously Lord King, have had experience of. I just want to get a sense of how those kind of meetings work, those informal relationships. I mean, can you just talk us through it, maybe without giving a specific example, but try and give us some light on how that relationship works between the Governor and the Chancellor, so that you're sharing views without actually infringing independence. Because this is a sort of grey area, and you could say, even to mix my metaphors, a black box in terms of how independence works in practice. So could you, Mr. Osborne, just...
I mean, I would say, I think the first thing I'd say is that I guess I was fortunate during the 6 years I was Chancellor that we never had a really sort of stressful situation where there was a kind of strong institutional difference in outlook between the bank and the Treasury and the rest of the government. So, it wasn't kind of tested to destruction, this relationship, either with Mervyn or with Mark Carney. But certainly the way I started, you start with respect. You start with enormous respect, I think, as the Minister for the Bank of England Governor and their officials and the job that they have to do, and you have to respect that they're not servants or, I hate the kind of, this applies more to the civil service, that's, we're the masters as the ministers and the civil servants are the servants. That's not, these are two different professions. And so I started with a lot of respect for Lord King and his colleagues, and a respect for their role. And then, what I sought to do, I think it was, by the way, entirely appropriate, but Mervyn King had reached out to me as Shadow Chancellor and had met with me on a couple of occasions beforehand, so that there was already, we had met and established that relationship. And I guess the main thing, it sounds, a bit old school, but it didn't feel like it, was we would have dinner once a month, either at the Bank of England or at number 11, or the Treasury. I mean, it was generally better food and better drink at the Bank of England than at the Treasury. But and that was and the only people that I would have with me would be the permanent secretary at the time, Nick Macpherson, and my most senior special advisor, Rupert Harrison, and Mervyn would have his private secretary with him, and there were just 5 of us, and we would talk about everything and anything, and it was not minuted. There wasn't a particular agenda, although we would both come with things that we wanted to discuss, and the private secretaries would have established in advance that these were things that both sides would like to raise. I would be really careful about overly sort of prescribing that conversation. You've got to allow a sort of safe space, if you like, where senior policymakers from different institutions with different can have that informal discussion. And in that informal discussion, I would say, I've got a budget coming up, I'm thinking of this, I might not do this, I might cut this tax, I might not. In other words, things that were highly politically sensitive, but I would trust, obviously, the governor, and this would also apply to Mark Carney, that he would treat that all in confidence. He might give me informal advice, not on kind of politics or fiscal policy, but on sort of overall economic policy, if I asked for it. And then, he would say, well, taking that into account, this might be the monetary policy response. And I don't think that in any way compromises the independence. The independence comes from the self-confidence of the institution. And that's how you actually make it work. And when it doesn't work is when those relationships break down and you can't have this conversation.
Very interesting.
I mean, again, very much continuity with the way things had been in the previous 13 years. I'd had a series of meetings with Mervyn when he was chief economist prior to the 97 election. In fact, I remember Gordon joked that the only person who actually was guaranteed a job in the new Labour government in 1997 was Mervyn, because the manifesto specified that the chief economist would become a member of the Monetary Policy Committee when it was established. And I also had very regular meetings with the then private secretary to the governor, Mr. Andrew Bailey, for months before the 97 election. And that relationship carried on. There was lots of change happening, and it was complicated. But actually, I remember when Eddie George stepped down his Mansion House dinner, he presented Gordon with an open letter which said, "Dear Chancellor, I have never had to send you an open letter." And everybody kind of smiled. But actually, that was in a way an expression of the warmth which was established over those years in that relationship, and that carried on with Mervyn. I think the one thing I would say is that it is more complicated since 2010 with the shifting of responsibility into the Bank of England and also the different deputy governors. There was an open conversation with the governor, but then the decision on interest rates was not made with the Chancellor, it was made by the Monetary Policy Committee with votes chaired by the governor. We're now in a different situation where you have, within the Bank of England, different decisions being made by different bodies with different deputy governors responsible. And there will be times in the future where there is a potential tension between the view of the systemically concerned governor, deputy governor, or the monetary policy making deputy governor, and then the micro-prudential regulating deputy governor. And I just think I'm not sure whether we've yet worked out the forum within which those conversations occur, including the Chancellor. In our time, it was always clear that the governor and the chief regulator, a direct line to the Chancellor. And that is less clear today.
How can I interrupt? You see, I think one of the reasons we brought about the reforms around financial supervision was precisely to force these trade-offs to be made and resolved. And so, I would take a practical real-world example from the last year. In the autumn of last year, the bank is trying to tackle inflation, and at the same time, there's a financial stability crisis in LDI pension funds. And instead of like the Monetary Policy Committee and the Bank of England coming to the Chancellor saying, well, we're sorry about your problem with the pension funds, we're doing this on interest rates, or we're doing this on quantitative tightening, and then some other regulators coming and saying, but we've got a real problem with the pension funds. You actually got Andrew Bailey as the sort of central point, who's having to reconcile both and comes up with a solution which is, okay, well, we're going to buy gilts for a week or two. And by the way, we're not going to put this to the Chancellor, because if we put it to the Chancellor, he'll want to buy gilts for the next 3 months, right? So, I think that was a good example of that, a really difficult situation where you had MPC objectives going one way, FPC objectives going the other way, and you force the institution that we've charged with these responsibilities to resolve that, and you force the person who obviously, you have by definition confidence in, the Governor of the Bank of England, to make the trade-off.
Well, I don't know if you want to discuss this now. I don't agree with what George has said, and I think there's some real issues here which we need to talk through.
Let's come back to it. I've definitely noted. I just quickly want to bring in Lord Griffiths, who's just... Do you want to come in?
Thank you very much, yes. Yeah. I warm to the idea that the Treasury and the Bank get on closely together. On the other hand, is there a danger the closeness becomes so great that you end up with fiscal domination and you end up with quantitative easing financing what the Treasury really wants?
Well, I think the Chancellor and the Treasury are responsible to Parliament for the setting and arrangements to meet the inflation target, and for the setting and the arrangements to meet the target for financial stability. So in the end, there has to be a dialogue which involves the Chancellor, because that is where the responsibility ultimately will lie, and also that is ultimately where the balance sheet guarantees will come from. So it would be a mistake to cut the Chancellor out of that. Second thing is, when you go to fiscal policy, fiscal policy is a matter for the Chancellor and for the Treasury. We can discuss this. I don't think there is any evidence that our system has done anything that allowed the proper management of the coordination of monetary and fiscal policy for over the last 25 years. And quantitative easing is an issue which is the responsibility of the Bank of England in meeting its objectives set by the Chancellor. And it's on that basis that the Bank of England has been held to account for those decisions. And it's on that basis, through the setting of the target, that the Chancellor is accountable to Parliament. I don't personally feel that anyone has established there has been either a conflict, a tension, a lack of accountability, or the wrong decisions made as regards either the coordination of monetary and fiscal policy. I mean, we could debate 2011 to 2013 later if you like. I mean, there I'm sort of, not fully sure. But as far as QE is concerned, I don't see the evidence.
Let's come back. We're going to come back to QE. I'm going to bring Lord Davis in a second.
Yes, our study is focused on the success of operational independence. The problem we have is that we've only got a sample of one. And given the experience, the varied experience of the period of the 25 years, with the movement of China into world trade, with the 2008 crash and the subsequent measures taken to solve that, and then more recently with what's happened in Ukraine and so on, COVID, it's very difficult in that whole mass of factors to actually pick out what bit of that was due to operational independence. Perhaps another way of asking the question would be, if the bank hadn't had operational independence, would anything have been any different? In which case, we can't really form a conclusion on independence.
Well, look, the first thing to say is that systems are tested in the face of shocks. And we've had a whole series of shocks. The semiconductor 98, then LTCM, then we had the tech bubble bursting, then we had the Iraq war, then we had the financial crisis, then interest rates stuck at the zero lower bound, then we've had a pandemic. And the reality is this way of making monetary and fiscal policy, but monetary policy in particular, has been robust in the face of those shocks, so that afterwards the system emerged and has carried on with continued political and public support. So I would say we have a whole series of points where the system could have failed and it didn't. And the one time where the system nearly failed was when politics looked like it was throwing into doubt the operation of the framework, independence, proper budget processes, the role of the OBR. That was the only point where we've had a crisis which looked like it was going to run out of control. And the reason we came through it was because the system was re-established. So I think I feel more optimistic than you about the operation of the framework.
I think you could point to two specific examples. I think if Mark Carney had not been an independent bank governor, I think his words on the immediate morning after the Brexit referendum would not have carried such weight in financial markets and calmed financial markets. I think if he'd been seen as a kind of, a placement of the government I was part of, the Cameron government, people have said, well, he's not going to be here for much longer because, there's going to be, the fact he was independent helped enormously in that situation. And I come back to the autumn of last year, which I think is a really important test case, because I think that's the first time in the last 25 years you've had a government that was not ideologically committed to independence of the Bank of England. I was bad-mouthing the governor of the Bank of England. And when it came to the OBR, which I know is not subject to your inquiry, was actively seeking to bypass it or indeed, I think, actually dismantle it. And if anything, I would like the OBR to be put on more of the independent footing that the Bank of England is put on, with powers to conduct its own forecasts, powers to request information from the Treasury, so you don't get the situation you got last autumn where the OBR, where the Chancellor announces what in effect is a budget, certainly the most consequential fiscal statement of the last 25 years, and the OBR was not allowed by the Chancellor to do its job. And I would learn from that experience and learn from the Bank of England's independence and find ways to make the OBR more independent and more robust in the face of political vandals.
Lord Davies, you want to come back in? Lord King.
Well, I want to start by thanking you both for doing two things. One is to spell out very clearly the arguments for independence, and as Ed said just now, there were an awful lot of shocks during that period which tested the framework. And then secondly, stressing the importance of the sort of informality of the relationship between Chancellor and Governor, which is necessary to make things a success, and can't easily be defined in terms of remits or changes to legislation which we as a committee might want to think about. It is very much to do with individuals and personalities and people being grown up enough to make that relationship work. And it, in my experience, under both parties, it worked extremely successfully. There was never a moment when either party or either Chancellor of either party tried to, behind the scenes, put pressure on the MPC to take a decision one way or another. So it has actually, I think, been extremely successful. But what I want to probe you on now a little bit is that get both of you to talk about the extent to which the remit and responsibilities of the bank have been expanded since both your times there. So even on the MPC, Ed, we've now got climate change and various other things added to the remit of the bank. What's your view about sort of going back to the simplicity and clarity of the initial remit? What's your view about how far it's changed? And George, the remit of the FPC is almost twice as long now as it was when you introduced it, What's your reaction to that? Ed, if you want to go first, and then George.
I think from the beginning in '97, we were clear that there would be a secondary objective. And the secondary objective was to support the government's objectives for growth and employment. And that was in the original letter, in the legislation. But it was always clear that that was a secondary objective. The primacy was the inflation target. And I think the importance of the symmetry and the importance of the open letter was it allowed the Monetary Policy Committee to explain that there would be times, we're going through one at the moment, where there is a shock which moves inflation away from the inflation target. And at that point, the bank has a decision to make about how fast to seek to bring inflation back to target. And it does so with an eye on supporting the government's wider objectives for growth and employment. And that is what the open letter system enables. It allows, I mean, clearly getting back to the inflation target is the most important thing, but the pace at which you do that. And I think that's been a strength. It concerns me, the idea that you sort of start to throw in to the mix other secondary objectives which aren't really directly affected sensibly by the instrument that the bank has in front of it, which is the interest rate to meet the inflation target. And I think if I was the Bank of England doing stress tests, one of the stress tests I would want to do would be to worry about risk and resilience as far as climate change is concerned. And clearly the MPC was always worrying in the period up to 2007 about whether or not wider financial stability concerns could impact upon the inflation target and wider objectives of growth and employment. But the government's got to be clear that the meeting of an objective like tackling climate change or reducing emissions, that is a matter for fiscal policy and regulatory policy and the government. And to start expecting the bank to lead on that doesn't seem to me to make any sense. Similarly, on the Financial Policy Committee side, I was supportive, and I think in the end we got to this point, that clearly there's an objective for financial stability, but subject to that, we wanted the FPC and the bank to have an eye on the wider impact on growth and competitiveness of the City of London and the wider economy. And that's important because in the same way as you don't want an inflation target which was as low inflation as possible is better, symmetry is important, you don't want to have an approach to financial stability which says, financial stability at all costs, because that would be the expense of the operation of the economy. There has to be risk and there has to be decision. And so that's something which needs to be in the mind of the FPC as it makes decisions to use, for example, macroprudential tools. I think there was just an inherent problem on the FPC side, which is it's easy to define the primary objective, the inflation target, to measure it, to hold the bank accountable for that, for the public, the select committee to see that, and then to have in that context the conversation about the impact on secondary objectives alongside that. On the FPC side, as the chair was saying about the remit, this is just much harder because it is very hard to specify the remit. It's very hard to therefore hold the FPC to account for the meeting of that remit, and there is a danger that there's insufficient scrutiny of the impact of decisions on those wider growth competitiveness objectives. I think in some ways it makes it more important that there is scrutiny, but let's be honest, as far as the FPC is concerned, there's much, much less scrutiny. The scrutiny is much less effective. There's a much less informed public debate. I think there's much less discussion in Parliament of the remit letter. So, my answer to Lord King's question is, on the FPC, I think the secondary objective is in some ways more important, but I worry about whether we have transparency and process and clarity which properly allows us to scrutinise that effectively.
Thank you. Sure.
Yeah, so I agree with you that, I agree with the implication of your question, which is that, we don't have to turn these letters into kind of Christmas trees where you put all your kind of baubles on them. And it should be straightforward enough to say, as a secondary objective, supporting the government's economic policy, and then, the government should be able to articulate its economic policy, so the bank should know what it is. And whilst I totally respect the desire to get all sort of arms of the British state trying to deal with the challenge of climate change, I don't think it particularly is necessary to sort of single out that objective amongst other economic policy objectives. I think on the FPC, I mean, I essentially agree with what Ed is saying, but I think it's, I think the FPC has been very valuable, a very valuable addition to the bank's tools, and I think it would be strange not to use these instruments to try and manage kind of broad, macro-prudential risks. They are intrinsically more complicated to understand. There are quite a few tools you can use, more than several, many tools you can use. I've read up on your sort of previous hearings with Paul Tucker and John Vickers, and I have a lot of sympathy with trying to encourage debate and voting, and we should probably give more thought to see how that could be introduced. But it won't always be straightforward because it's not just one target and one instrument as there is on the MPC. Although I guess MPC has found some new instruments with things like QE. But I'll give you a kind of practical example. The FPC makes very important decisions about mortgage affordability, which has real-world consequences for millions of families about whether they can afford a home or not. And it is self-evidently the case that it is much harder to get a mortgage these days than it was 30 years ago. And as a result, people in their 20s and 30s find it harder to get on the housing ladder. Now, that might all have been done for good policy reasons, i.e. to make the country more resilient to financial shocks, to make bank balance sheets more robust, to make sure people didn't get themselves into debt situations which they couldn't afford. But whilst Parliament in the House of Lords and the House of Commons goes around talking about home ownership, the regulatory system, the FPC and so on, has made that more harder and harder in one particular angle around mortgage finance. And I don't think that is properly understood and properly debated, and I don't think parliamentarians give it sufficient attention. And I think, it would be good to come up with some ways to articulate these choices more clearly, explain the real-world consequences of counter-cyclical capital buffers and all that kind of thing, which is very technical, but does have enormous consequences for the ability of a small business to get finance, the ability of a family to get a mortgage, and so on. And by the way, the committee knows what it's doing. It is, it's not that the people on the committee don't know that they're doing this, and they're doing it in good faith. So I think we could find ways of sort of simplifying the consequence of these decisions, or explaining in simpler terms the consequence of these decisions.
Very good. King, do you want to come back in on any of that?
Can I just ask you very quickly to say, if we could sort of turn the clock back to happy days and you were in power again and you had the chance to simplify some of the remits, would you want to do that or not? It's
a good question. I think in the kind of governance of the Bank of England, I think we could have a good conversation with the governor about and the FPC about how to simplify the remit, how to make its decisions more transparent to people, perhaps to have a conversation with how Parliament can engage with those decisions and scrutinise them. And I thought there was another point. I think, this is obviously difficult territory because I have great respect for all of the current incumbents, but maybe there are too many deputy governors, or we could somehow create some sort of hierarchy amongst the deputy governors, which I know is something previous witnesses have raised. So, I think there are sort of tweaks to the system you could make, but broadly speaking, it ain't broke, so don't break it.
I think. I would go further than that. Not on the monetary policy side, where I think the specification of the target and the way that there's accountability seems to be working, even in difficult times. I don't think we're ever going to get to something as equally clear and simple on the financial policy side. But there is a problem. George alluded to it. The reason we don't have a Fiscal Policy Committee is because in fiscal policy, the decisions the Treasury are taking around tax rates are first order distributionally differentiated. You know, a tax change, there's different tax rates for different individuals or in different parts of the country sometimes, affects people directly. In the case of interest rates, in first order terms, when the bank sets the interest rate, it's the same interest rate for everybody. I mean, of course there are second order distributional impacts, but it's one instrument. When you go to the FPC is making decisions which are more like fiscal decisions than monetary decisions, in the sense that if you take loan-to-value ratios, for example, they have different levels and impact differently on different groups of people. This is politically more contentious, and I don't think we can simplify that. And I absolutely want operational independence for the bank, the macroprudential decision maker, to use those tools. What I worry about at the moment is that that on the financial policy, the bank is too exposed. I would like there to be more cover given by the Treasury and the Chancellor to not just the objective, but the operation of that objective 6 months to 6 months, to try and get closer to the way in which the Treasury owns the inflation target. And one of the things that I've proposed is that we don't simply have a letter sent by the Chancellor to the FPC on an annual basis, but maybe more often, maybe quarterly or 6 monthly, the Chancellor brings together the governor, but also the key deputy governors who are leading on macroprudential supervision and on monetary policy. There is a conversation about risk and macroprudential risk, the things which are on the agenda. From that meeting, the Chancellor then gives a remit which might have a bit more detail in it. It's then for the FPC to make its decisions, but to meet a remit which has been discussed in the group, but also with more specification, and in which the Chancellor kind of gives more political cover. What worries me at the moment is if something was to go wrong at the moment, I think the Bank of England on the financial policy side is quite exposed, and I would rather that the Treasury was kind of more engaged. If you look in America, they have an equivalent. They have a committee called the FSOC. I'm not saying that that's a good parallel, because there's lots of complications, but the American system is different from ours and complicated. But essentially, the Treasury Secretary chairs a group which brings together the key players to look forward in terms of the macroprudential developments on the economy. That's a good thing. And I think if George or I were Chancellor now, I don't know, I can't speak for George, I think that finding a way in which the Chancellor can own the financial policy objective in a more detailed way, as is clear on the inflation target, would give the bank some protection.
Very good. Looking is that.
So one last very quick. I take it that although there are some differences of perspective in what you do on financial stability, neither of you are keen to either retain or add to the baubles on the Christmas tree.
No, I think it's a good exercise, isn't it, every few years to try and simplify these things. And I think
Very good.
thin down the remit better.
Lord Turnbull wants to go in with a quick question.
You've outlined how the FPC is taking decisions which have strong distributional elements. They're making them more like tax decisions. There's one other factor which I don't know quite how they deal with it. Let's say careless talks cost lives. That you want to talk about some sector, you think not quite happy there. There's a risk here, there's a risk there, and the last thing you want to do is put that out in the public domain, because you precipitate the very thing that you're trying to prevent. And that, I think, maybe the answer to that is there needs to be more discussion between the bank and the Treasury, so that they have an absolute sharing of where these risk factors are, who could be on the brink, and where you might need to intervene. But you don't share that with the wider public and, as I say, precipitate what you're trying to stop.
Personally, I strongly agree with that. And I think in a crisis, the reality is the Chancellor is going to be chairing the meeting because they have the balance sheet. And in a crisis, it's not enough for the Chancellor only to hear from the Governor, because there may be within the now Bank of England families different views between the microprudential regulator or the monetary policy maker or the governor about where risk lies. And I think if I was the Chancellor, I'd want to hear those different views rather than them all being siphoned through the one individual, the governor. That's why I don't agree with the way George specified the last autumn conversation. And if you have a regular place where that conversation occurs, it doesn't have to be minuted for exactly the reasons you said, but which is also the place where the remit is discussed. You established in good times the relationships which you will then need in more difficult times, and you don't have to invent an ad hoc group because you've already got the group established and working. So having a forum where it needs to be two-way, the flow of information between the Treasury and the bank, and not one way.
Very good. I'm going to move on to Lord Rooker.
Yeah, good afternoon. I'm going to ask about scrutiny of the remit, and in some ways the extensive positive answers you've just given to both previous questions in some ways cover aspects of it. But I was very struck with what William Hague wrote in the Times this morning about MPs have got no time or less time than they used to have to spend on national issues. And the words Treasury Select Committee has not crossed anybody's lips yet this afternoon. So I'm going to ask, do you think the remit letters receive an appropriate level of scrutiny? And is there a case for a bit of prior scrutiny by the Treasury Select Committee before they're issued? I mean, we get transparency afterwards, but and notwithstanding what you've just answered to Lord Tumblr, I can understand the reason for saying no, but is there not a case for a greater degree of education of the public and indeed members of the Commons who, according to William Hague, and I think he's probably right on my experience, are spending less time on national issues than they used to?
Well, look, you know, I can only speak from my time in Parliament. The Treasury Select Committee was a pretty effective and tough forum to appear in front of as Chancellor. And, you know, I would have two kind of scheduled meetings a year, one after the budget, one after the autumn statement, and I would spend a lot of time, given that I also had a lot of other responsibilities, a lot of time preparing for those meetings. But they did have the element of a kind of gotcha encounter where there were, you know, a couple of rising star Labour MPs, one of whom is now Shadow Chancellor, out to make a name for themselves, and I don't, you know, that's what I was doing back then as well, you know, and I was an opposition MP. And you also have a couple of unfriendly members of your own side also trying to get you, who were harder to deal with. So it had a kind, you know, it was certainly a lot of heat. I'm not sure there was that much light. And therefore, I wonder whether you could find, whether it would be around the remit letters, another occasion where a Chancellor could go, and it was sort of generally understood with the TSE that this was not the kind of big sort of, you know, showdown in a highly charged week where you've just done the budget and it's being argued over by the different political parties. And something that, you know, and I was certainly speaking entirely personally, I think you would get more out of, you would have got more out of me in that encounter rather than my kind of fences up and, you know. So I think that is the case. I'm not sure about I mean, it'd be an interesting question whether, you know, you know, we have to confront the reality that our constitution is, if we can describe it as such, means the executive is in the Parliament. And so I'm always a bit nervous of saying, you know, parliamentary committees, I'm talking here about the House of Commons, should have got vetoes on appointments or, you know, vetoes on things like remit letters, which go to the core of the government's economic policy. Because in practice, you know, a government should have a majority in Parliament, and then it would kind of create all sorts of complications if you're trying to pretend this committee is independent when it's not really, and it would put even more, it would, in practice, let's be honest, you know, and I can say now I've left, you know, you'd be going to the chair of the Treasury Committee and say, well, if you behave yourself, you'll be a minister in a year's time, right? I mean, So, I think you would, the more kind of weight you'd put on that body, the more you'd force the executive to corrupt it, essentially. So I wouldn't I wouldn't give it too much, I wouldn't give it sort of executive power, because then the executive will want that power and find a way to get that power. But I would give it more opportunity for scrutiny, and I would find at least one occasion a year where the Chancellor has a less confrontational encounter with the TSC.
I think the thing I would say is, I think on monetary policy and on fiscal policy, I think parliamentary scrutiny of government decision making is effective and has become markedly more effective over the last 30 years, over the 30 years since I was first in this place in the early 1990s. And part of the effect of the 97 reforms on monetary policy was to enhance the debate and scrutiny. The fact that we had MPC members making speeches, disagreeing, voting differently, once we got used to that, was hugely positive for the public debate. And I think we had, on monetary policy, we have had in the last 25 years, one of the most educated debates about interest rate decision making in any developed economy. And I think that the reforms and the way in which the bank empowered those reforms and encouraged, as Mervyn did in particular, different people to take a different view, that has been really good. We don't do the same on financial stability, financial policy. When I was a minister, I was being summoned to hearings about cash machine charges or travel insurance, but we weren't talking a lot about macroprudential stability. I would be surprised if you spent a lot of time talking about those things. There was a period where Andrew Chirey chaired the Banking Commission where Parliament did play that role, but then that was for a short period. And I think it may be inherently more difficult and more complicated. I mean, that just may be a fact, even though we know its impact on family finances and the economy is huge. But it might be, to go back to a point we made earlier, there's very little scrutiny of the FPC minutes because they're quite boring, because everything is consensual, there aren't votes, people don't express differences of view. As Lord Turnbull says, you have to be careful about how you express differences of view, but I think that the parliamentary debate and wider public debate will follow from whether the Bank of England feels confident to air those debates in public. And I think we have been much, much more confident talking about those things on the monetary policy side in the last 25 years than we have on financial policy. So I know, reading the transcript, that both John Vickers and Paul Tucker made this point, but there has not been groupthink in monetary policy for 25 years, but I think there's more structurally we could do to move away from consensual thinking on the financial policy decisions. And of course it was really difficult, 29, 10, 11. I mean, I don't dismiss how hard it was to introduce these reforms, but I wonder whether evolving that and having more confidence in disagreement, or at least discussion, would lead to a more enhanced parliamentary debate and better scrutiny and accountability.
Can I just follow? That's very helpful, by the way, both answers. We'll just follow up to Mr. Osborne about if you could elaborate on the process of the development, because you obviously had the opportunity over several years producing the remit letters. I mean, did you, for example, before you issued a remit letter, check it for consistency with the previous one that you did? And in that respect, as you've clearly both done your own work, so you'll have read the exchange I had with Paul Tucker a couple of weeks ago when I pointed out that in 2021, which was Rishi Sunak's letter, it contained in a very clear paragraph, paragraph 2, quote, "The government's commitment to price stability and the Bank of England's operational independence remains absolute." The exact same letter with the exact same paragraph from Jeremy Hunt in 2022 did not contain that sentence.
He really needed to say it in that situation. I thought it was a very interesting question, and I was wondering what the answer was. There was certainly, amongst the kind of policy decisions that I took as Chancellor, we would spend quite a bit of time on the remit letters. And, we did consider in 2012, 2013, in discussion with the governor, whether, for example, we explored, we never got beyond kind of first base on this, but, could you change to sort of something like nominal GDP targeting or average inflation targeting? We had lots of discussions about credit conditions in the economy, and which ultimately led to the funding for lending scheme from the Bank of England. The remit and the remit letters did look at, in fact, I think the last remit letter I sent to Mervyn was open the door to forward guidance, and we'd actually changed the remit and allowed the committee not to take a number of years to return to target if it wanted to do so. So we did spend a lot of time considering. I have to say we spent much more time thinking of changes which we then actually didn't do. So we spent an enormous amount of time, I seem to remember, in 2012 thinking about nominal GDP targeting, and came to the conclusion that would be a pretty bad idea. But it was aired within the Treasury, and it was aired in the kind of just private discussions with the governor. So I certainly feel it was not a kind of routine task in the Treasury when I was there, because we were dealing with a situation of an ongoing credit crunch essentially, and the government and the bank, the interest rates already at the lower bound and so on. So it was given proper consideration, and there was and we had top officials in the Treasury were engaged in it.
Very good. That's a very, very good way to segue into a question from, conscious of time, to Lord Lonsborough wants to put.
Thank you. Can we now return to the quantitative easing, and in the current climate of high inflation, the unwinding of QE? So over the last 12 years or so, QE, in the wake of the financial crisis of 2008, has grown cumulatively from £200 billion to almost £900 billion post-pandemic in 2021, with events such as the Eurozone debt crisis and Brexit triggering fresh bouts of QE along the way. And as a result, the bank's balance sheet had grown by almost 500%. So my question for you both is really in two parts. The first is, do you think that the bank's deployment of QE has impacted on its credibility in relation to its primary task of controlling inflation? And secondly, has QE, particularly the extent of it and the size of the bank's balance sheet, served to compromise the bank's independence?
I mean, the answer to both questions, I would say, was no. First of all, I think it was to the credit of the bank and the then government, the Gordon Brown government, and Alistair Darling as Chancellor, that they developed the QE framework, and I said some foolish things as Shadow Chancellor at the time about it.
I remember.
But sure enough, when I was actually in the real job, I adopted wholesale the Alistair Darling framework that had been agreed. So, and I think that did show kind of policy innovation in an exceptionally difficult situation for the country and the world. I'm not really qualified to. I mean, I think it's a bit harsh to sort of second guess the bank in 2020. Again, that was an exceptional situation, a pandemic, which none of us had seen in our lifetimes, a disease whose impact none of us knew the extent of. I mean, I always remember, I would make a broader point, about lockdown. In those first few months, we were all very scared of getting this disease. I mean, we became less scared as vaccines were developed and so on. But, and there was a shock to markets in March 2020. And the Bank of England was, I think, worried about liquidity in the system. And so I think with hindsight, you can say the combination of QE from the central bank's very loose fiscal policy, not just here, but particularly in the US, which then continued over two administrations in the US, contributed to the inflationary problems. But it's a bit harsh to kind of second guess the policymakers in the spring of 2020 when they were faced with a really, essentially in the modern era, unprecedented situation. I would also say that I think QE has become a bit of a kind of bogeyman for basically the failures of democratically elected governments to do things about. So it's become the kind of bugbear for distributional impacts in society, which have seen people with capital get richer and, but that's the role of governments to do something about rather than blaming QE, in my view. And equally on kind of debt sustainability and all of that, I certainly never thought when I was running a kind of high budget deficit and trying to get it down that it was okay because the bank's going to be buying all my gilts. I was very conscious that we had to maintain credibility in the gilt market, and we didn't want failed auctions and the like. And ultimately, as you see, indeed with the present government, they are aware they have to convince markets and have come up with, they don't like to use words, but austere policies to try and restore credibility and get the finances into better shape. So I think QE kind of has become a bit of a kind of way out from much harder questions that should be aimed at democratic politicians about how they're going to, increase opportunities for lower income people, people on lower incomes, and how they're all going to do that at the same time as managing public finances in a way that you don't lose confidence in markets.
My answer would also be no to both. Of course, it is the case that as QE unwinds and as interest rates are rising, this is going to impact upon the government's fiscal balance sheet, and the government will absorb that. And if it doesn't, then suddenly we would be having a different conversation about QE. But I'm sure it will. But I don't think there is any evidence that the Bank of England has taken decisions other than to meet its inflation and financial stability targets. I don't think there's any evidence that it took decisions it wouldn't have made to meet those objectives because of pressure from the government. What I think is true is that there were periods when interest rates were very low and where the bank was worried and thought, well, maybe some more QE might help. And it probably didn't help a huge amount. But I don't think it did any damage. If you go back to March 2020, at that point where markets were dysfunctional in the way they were last autumn, QE played a hugely important role and was going in the same direction as fiscal policy as well. The evidence that QE actually has had big impacts on either interest rates or behaviour or inflation or economic outcomes outside those periods of kind of gross market instability is pretty weak. So when I say, I think probably there were periods when the bank was looking for levers and thought, well, there isn't any harm doing a bit more. I don't think it potentially did a lot of good, but I think equally, nor did it do a lot of harm, because I don't think it was hugely effective. I don't think those shifts in asset classes will make a lot of difference. What it has done, as George says, is complicated political narratives and given a stick for some people to beat the bank with. But aside from the politics, in terms of the economics, outside those unusual and important moments, I think QE is just not that important.
Lord Laird wants to come in, and then Virgie.
Yes, I just wondered if you could clarify how you think about what is going on when you have the zero-bound problem. Because normally the theory is, isn't it, that the government does the budget and the bank controls the inflation rate through the employment rate. So the bank is in charge of the employment rate. But when you have the zero-bound, it begins to lose control of the employment rate, and therefore the fiscal side has to become more involved in the determination of employment. But how did you see that playing out during the zero-bound period?
Well, I would say that we were sort of saved by the bell, if you like. I mean, right at the moment, and this wasn't just here actually. I seem to remember the Bank of Japan was sort of leading the charge on this. There was all sorts of talk of what's the next stage of sort of monetary, intervention and innovation, which at some points were going to look dangerously like monetary financing. At just that point, the kind of world economy started to pick up, and the sort of issue started to go away. I think. But we were beginning, to have those conversations in 2013. Is there more you can be doing in the monetary space? I would still, it's still a kind of interesting toolkit. There's now an expectation, isn't there, in any kind of downturn that the world's central banks are going to step in and stop it, and not a downturn caused by them policy to control inflation, but a sort of any kind of crisis. There'll be a massive release of money into the system, and I think an expectation that if that doesn't work, they'll release even more money in. And I guess we never really kind of quite reached the point where we started to examine what the more exotic instruments that you could start to deploy in a system like ours were.
Mm. Although in that period, to go back to debates of 10 years ago, rather than exotic instruments, you could have just used fiscal policy more in 2011, 12, 13, and that was a choice that the government chose not to take. In the pandemic in 2020, interest rates were low. There was some QE, but the work was done by fiscal policy, rightly. In 2007, interest rates were higher. They came down. The work was done by fiscal policy primarily in that period, and with the banking crisis. Last autumn, there was instability, but actually there was inflation, so monetary policy was going in a different direction. But you could have decided in 2010, 11, 12, 13 to have a more supportive fiscal environment.
Old parliamentary debates.
I mean, look, the reality is that
we still had the strongest growth in the G7.
Yeah, well, I think the reality
is warming up for our.
The reality, as the OECD numbers show, is that for all of the rhetoric of George, he actually moved fiscal policy from seeming to be about reducing the deficit to being mildly supportive of fiscal policy. So he actually did become more fiscally active. He just didn't want to tell anybody that was what was going on.
That's the best way around to do it.
What actually happening. And, so you could have just had a little bit more courage of your convictions.
Well, Virgie, did you want to come in quick?
It's not our remit to look at individual policies at the moment. But, if you look at where we are today, you could make an argument that the Bank of England has got it completely wrong. I mean, inflation has got completely out of control, and something is going wrong. And I buy, Mr. Osborne, we are in unprecedented times of the pandemic and the war in Ukraine, etc. But, we've got someone who's got it completely wrong, and then we're asking those same people to fix the problem. Is that a flaw in the system? And how would you fix that flaw if it is a flaw? It seems to me, a crazy situation where someone who's got something completely wrong, and you go back to them and say, okay, well, now you fix this.
So first of all, I think, all central banks were probably slow to spot the inflation problem, which came kind of, I would say, largely unexpectedly. I know there were some people who forecast it, but largely unexpectedly out of the sort of tail end of the pandemic and the lockdowns, and was, in my view, turbocharged by fiscal decisions in the US. So I don't think the Bank of England can be sort of singled out among the central banks. If anything, it was actually one of the first movers. I think it might have been the first mover. And I would say it's got on its kind of credit, on the credit end of the balance sheet, it's dealt with the exceptionally difficult situation last autumn. And the reason I bring that up, I brought up earlier, is that was the time when you had an elected government in this country challenging essentially the legitimacy of the bank governor and the Bank of England. You had a self-induced financial crisis within this country alone at the time, and the bank managed to navigate through that, and it was the bank's credibility that actually started to restore confidence to the markets, which then was followed by the change of government that was able to do that. And I would say, taking a recent example, you've had, I'm not saying these were, the challenge was quite as large as in the US or in Switzerland, but I would say the Bank of England handled the Silicon Valley Bank UK situation far better and with more clarity than authorities elsewhere were dealing with. We did not get into a situation of guaranteeing all deposits as the US did, and we did not get into a situation, of the kind of confusion about equity holders versus bond holders that you saw in Switzerland. And so I think, the Silicon Valley Bank UK failure was handled very professionally by the bank, and it was shepherded into the hands of a...
Just if I may, sorry, just to interrupt, I'm sorry, I'm conscious of time. Just putting the question a bit more directly to you, Mr. Balls. I mean, just picking up on your point, Reggie. I mean, we've been going on for an hour. We've had basically everyone saying that, you're both saying that the bank has got a pretty good clean bill of health. In fact, it's succeeding. I think, Mr. Balls, I noted that you said that we've avoided groupthink in monetary policy. Out there, if people had listened to the last hour, they'd say, what a planet is everyone on here? We're seeing inflation running amok, and the bank seems to have potentially been asleep on the job. And Mr. Osborne, you just then said, well, actually all central banks actually were behind the curve. My question, therefore, to you both, or actually may I just put it to you, Mr. Balls, is what, if anything, can we learn here about what's happened in terms of the track record on inflation over the last year? We were repeatedly told in this committee, as elsewhere, by a number of members of the Bank of England, don't worry, it's transitory. Basically, what I'm hearing is the structure's fine, the accountability is fine in the bank, and actually everything is just a factor of groupthink globally. And I'm trying to see what I'm missing here and whether or not there's any lesson at all we can be learning from what's happened. Mr. Balls,
I think, I mean, the economic policy decision maker doesn't have the benefit of our hindsight. That's just the nature of the task. So we can, we talked about the robustness of the system, the monetary policy decision making process of the Bank of England in the 2000s, but the reality was in 2005, 6 and 7, when there was a meeting of the Deputy Governor for Financial Stability in 2006 and the Treasury and the FSA, nobody, all backed by big capabilities in their own institutions, was seeing the risks which were rising in our economies and communicating that either to the Treasury or to the Monetary Policy Commission. That's just a reality. But we now know that, and we've learned from that, but we've managed to... But the system was robust to those decisions. Now, when you move to the last 2 years, the reality is supply chains had worked better through the pandemic than any of us thought. I don't think people foresaw the extent to which there would be disruption after the pandemic in the re-establishing of supply chains and its impact on prices. I don't think people foresaw the fact that we were going to have a war in Europe and its impact on energy prices, and we didn't foresee the extent to which the labour market would bounce back as strongly as it did. And the worry when we were talking about the end of furlough was whether we were going to see a huge rise in unemployment in our economy. In fact, things went the other way. So, with hindsight, of course, it would have been better if we had seen these inflationary pressures. The question is, how did the system deal with the inflationary pressures when they arose at that time? And, we could have a discussion about, imperfection in communication, because of course there's mistakes made. And we could say, well, the Bank of England went first compared to other central banks, but maybe we should have gone earlier. And then the Bank of England went first, but then maybe it should have then been a bit more aggressive in the early phase. But the reality is that the inflation target means when inflation goes outside the inflation target, you raise interest rates, get things back under control. And that is what the MPC and the bank is doing, I would say, with broad-based public support. What is very striking to me is how there's a lot of criticism of government fiscal policy and energy prices, actually, so far, there's not been a huge controversy around the rise in interest rates and mortgage rates, other than for a few weeks in the autumn.
That's because the government gave it cover.
When there was complete carnage.
Okay, I'm just going to, sorry,
I think with the benefit of hindsight, they would have done things differently, but actually that doesn't mean that the system hasn't worked.
Okay, so Baroness Cranach.
Well, I just wanted to push a little harder on Lord Bridges' point, which is we're very good at learning, the lessons with hindsight. That's what we did wrong. Let's make an adjustment. Let's do this differently. But we appear to be in an era where every time you turn around, the unexpected unknown, or whatever phrase you want to use, that comes and whacks the system in a way that seems to be, from a regulator's perspective, completely unexpected. And we're in a time too when financial markets move very fast, individuals get information instantly, individuals move money instantly. So is there some change that you could see in the way that the system is set up that would give us the capacity to anticipate risk more effectively and to deal with risk ahead of the crisis hitting us square?
I think it's quite... I think there are certain things which is extremely hard to... don't want to go all Donald Rumsfeld on you, the kind of unknown unknowns. Yeah. it was... I know there's going to be there's a COVID inquiry underway, but the idea that the whole world should have anticipated that there'd be some brand new virus, and I question whether in reality you can kind of plan for every single contingency. I think what is fair to say, though, is there are things that are obvious now that perhaps we should be doing more thinking about. So it is obvious now that these bank runs happen in minutes, not days and weeks. And there's no point sitting around for years thinking about that. It is the case. The Silicon Valley Bank UK, Credit Suisse, money moves unbelievably quickly in a digital banking age where people can move quite large corporate deposits extremely quickly. So these runs are much quicker than they thought. I think the other recent lesson has been to sort of think that smaller banks can be allowed to fail without any kind of broader systemic impact is a mistake. It turned out that in the case of Silicon Valley Bank, it was connected to a particularly important ecosystem around tech and tech startups and whatever, and policymakers sort of after the event, if you like, suddenly realised this bank was systemically important, but not in the way that they had previously conceived. I think the other thing, which I don't know whether you want to get into, a lot of these very large... One of the consequences of the financial crisis, all these years on, 15 years on, is that we've actually got a smaller number of very large important banks, mainly American. So there has been largely a clear out of European large investment banks over the last 15, 20 years. And you've got a small number of... And, to what degree do we rely on kind of international cooperation to resolve these institutions, and do those international arrangements stand up to scrutiny? Would it actually work in a crisis? In the case of Credit Suisse, the Swiss authorities, and I'm not second guessing them, it's an incredibly important institution for Switzerland, and there's some evidence now that it was written into the bondholders that they would get wiped out if there was government intervention. So there was sort of logic to what the Swiss were doing, but it was certainly came as a surprise to the UK and US authorities what was happening to what is an important institution in London and New York as well as in Switzerland.
Sorry, I'm going to jump in because I'm very conscious of time. Do you want to have anything to quickly?
I would like to say in a second just one thing about the MPC-FPC relationship, if you would allow me to, because we referred to that earlier. Yeah. But just to answer Baroness Kramer's point, look, we've been talking about ways in which we can improve scrutiny and public debate and accountability through the session, and I think that's particularly the case on the FPC side. But the reality is that a global financial crisis, we thought this was a once-in-a-century event, and then a pandemic, once-in-a-century event, leaving the European Union, war on the continent of Europe. We've had 4 once-in-a-century events in 14 years. I mean, it's astonishing, the scale of shocks. So I would just say, of course it's imperfect, and of course we could have done things better, and of course the system could be improved, but actually, the fact that we've ended up coming through this with a system which has been consensual for the last 25 years with changes at the Bank of England still intact and working, it's actually a triumph.
Excellent. Okay, very good point. I'm going to bring in Barrister Bill.
Well, my question was to some extent covered earlier, but listening to Baroness Kramer and to the responses to it, do we need to sit down and look again at the structures that exist around the bank and the relationship between the bank and the Treasury? Because things do move at a much faster rate than we've ever seen it do before. And how can we secure financial stability and price stability within that kind of environment? We need to look ahead now and try and find structures that fit. And I first started thinking about this following the Quasi-Kwarteng's budget, because there seemed to have been shortcomings in relationships during that time. So how do we improve them? How do we make it work? There are good things in what's happened so far, but how do we make it better things for a much quicker moving economy and international scene without baubles in the Christmas tree?
Don't really have a simple answer, because I started right at the beginning by saying ultimately the system depends also on the individuals at the top. And you can build in all sorts of try and sort of contingency and sort of fail-safe mechanisms to protect the Bank of England's independence in extreme situations, for example. But, you know, if you have a chancellor who goes around saying he's going to fire the governor of the Bank of England, that's quite hard to deal with that. Although, I guess in the end the system fired him, so...
We can have a legitimate debate about whether it makes sense to have macroprudential and microprudential supervision in the same institution, but actually destabilising systems, you have to have a really, really good reason to destabilise them, and I don't think there's a really, really good reason at the moment. So I understand why we did what we did in '97. I understand what George did in 2010. I'm not sure I would destabilise that. I'm worried about the two things within the system. One is I am worried about the MPC-FPC relationship, because I think, as George said, in this complicated, fast-moving world, there are issues which do potentially impact upon the remit of both committees. And at the moment, we have a system where you have a group of Bank of England full-time executive members who attend both committees, and then independent members who only attend one or the other. And I think if I had been an independent member of the MPC in the autumn, seeing decisions being made in the FPC which had a direct impact on the potential outcome for the thing for which I was accountable, the inflation target, on the basis of a meeting and a conversation I wasn't at, but the chair of the MPC was, I think I'd have been unhappy about that. And I think that may arise more often in the future. Now, one solution would be to have one committee which looks at monetary and financial policy considerations. I know that there's risks in that, because the danger is that the MPC process, which is more clear and more monthly, ends up taking precedence. There's an alternative approach, which, I mean, I think actually, as I understand they do in Malaysia, where they copied our system, have an MPC and FPC system, but where any member of the MPC or the FPC has the right to trigger a joint meeting of both groups if they think a decision is arising or a risk is arising which they think will cross over both. I just think we need to think about protecting the independent members on one committee or the other from decisions happening outside of their committee which impact upon their the remit. And that's why I said at the beginning that I was more concerned than George was about the MPC-FPC process in the autumn. And then, as I said earlier, the second thing I would do is I would try to have on financial policy, where accountability is necessarily more opaque and where clarity of objective is harder, but where political risk for the bank is greater, I would rather there was a more structured conversation involving the Chancellor and the senior members of the Bank of England on a regular basis, to have the kind of conversations Lord Turnbull talked about, and for there to be a more textured conversation about the remit. I don't think you need that on monetary policy. I think the monetary policy observer on the MPC is sufficient. I feel it is not on the FPC side. And I think actually the Bank of England is too exposed, and a Chancellor ought to want to be giving them more cover on financial stability than we're giving them at the moment.
Very good. Baroness, do you want to come back in? Or?
Yeah, just one very, very quick point. Do you think that financial stability and price stability should be regarded as separate areas for consideration? I'm getting the impression that the line that you're taking fuses them more together.
I think the Bank of England must have a role in monetary policy and financial stability policy. And when we made the reforms in '97, from the beginning, we established a second deputy governor, as well as the monetary policy deputy governor, for financial stability. And that was contentious at the time, because there were senior members of both the Bank of England and the Treasury who didn't want the Bank of England to have a deputy governor for financial stability. They wanted that to be separated, but that would have been the wrong thing to do. But I do think that they are separate tasks with separate tools and separate objectives, and often they can be pursued separately. But there is clearly an overlap where decisions to meet the financial stability objective can impact upon the inflation target and vice versa. And at the moment, I don't feel as though we discussed that enough. It's partly because the FPC process is also too opaque.
Mr. Osborne, do you want to come in quickly?
Very briefly, I'm talking my book here, but I think the reforms in 2010 to bring microprudential supervision under the remit of the Bank of England was very important, which was taken away from it in 1997. And, whilst I, as I said right at the beginning, support the changes made in giving the Bank of England independence, I think it was a mistake to take away from it the responsibility for supervising the nation's banks. Because the kind of judgment-based long-term prudential regulator sat uncomfortably in a rules-based conduct regulator, and the Bank of England, I would observe as an outsider, lost some of its knowledge of what was going on day-to-day in the financial system, and you had unusual judgments like allowing the Royal Bank of Scotland to take over ABN AMRO in the middle of a banking crisis, which exacerbated the problems that the Royal Bank of Scotland had, and I'm not sure a Bank of England-led prudential regulator would have allowed that kind of thing to happen.
George, strongly advocated at the time by the Bank of England.
A bit.
The Bank of England was not objecting to the...
I thought Eddie George was not very happy with losing banking system.
No. In terms of the ABN AMRO, look. I mean, this is a really interesting conversation, and actually, have an open mind about the system now. I'm not saying we should go back to how it was, but it's really important to remember what was happening in 1997. You were establishing for the first time an independent Bank of England with huge new responsibilities. Separately, you were establishing for the first time statutory regulation, which was an enormous management and legislative task, bringing together a whole series of non-statutory regulators into one place. Our judgment at the time was that was too big a task for one institution to do, and you couldn't establish the FSA without banking regulation. Hence, we went down that road, strongly supported by Lord King and others at the time. And then, in the period where the tripartite system was operating, the Bank of England had a huge department for financial stability and a deputy governor for financial stability.
But it wasn't in the day-to-day. That was deeply understanding these complex.
That was a choice for the Bank of England to make.
Very good discussion.
Choice to make at the time.
Lord Turnbull, do you want to quickly just come in on
just to amplify the point which Ed Balls has made about the relationship of these three committees? I think those three committees, I agree with them, should be inside the bank, and what the bit that's outside the bank, the FCA, is the bit that should be outside the bank. But the relationship between the three is, what one is struck by is, goes the governor and three deputy governors, and they go to all three. It's not necessarily the same three, but there's a tremendous amount of overlap. Let's call it the caucus. And I think the effect of that caucus on all three of those committees must have some impact on dulling the debate that takes place, because they are so kind of preeminent, because they're the only ones that go to all three. I think for the outside members to challenge them, given that they've got much less information, much less standing, I think it's quite difficult.
Quick response, because I'm very conscious, thanks to my lax timekeeping, that we're running out of time. So,
I think it's a very fair point. I think that's worth sort of further examination. I think you could look at the number of deputy governors without being disrespectful to the current deputy governors. I also think, and again, I very much don't want to be disrespectful to either Dave Ramsden or John Cunliffe, who are excellent public servants, but I wouldn't want the Bank of England to be in the habit of taking just Treasury officials being the main source of
Old boys
officials, much as we love the Treasury.
You might want to come back to this.
And so I think, I would look at that. I think there's a general challenge, which we did actually look at in the Treasury while I was there, which is how can we get the sort of British economic establishment and the universities to produce more, to produce people with sort of big macro views of the kinds that the American institutions like Harvard EdWorks seem to churn out, and as a result, finding people to serve on the MPC as external members who are British was actually becoming harder and harder once you'd gone through all the kind of obvious candidates.
I'm going to interrupt, I'm sorry, because we're going to come back to that in just a second with others. Lord Layard, do you want to come in?
Well, actually, everything I was going to ask has been covered.
Very good. That's a very quick point. Unless you want to ask anything else, Lord Layard, very briefly.
Well, I would love to hear a little more about this, because there's the supply side, but also the demand side. I mean, the appointment system is not really the same as the standard appointment system for, say, judges. If you set up a system like that, where people would more naturally come in from the outside, you might find the supply responded too.
Yeah, I would just look. It's a very hard problem to solve. I would say there's a general. I was someone who was active in politics for 20 years, and there was remarkably little interaction between government and university life, in a way that you don't see in the United States, where there's a lot, and that's because the United States. And I teach. I'm a teacher course at Stanford University. Ed is at Harvard University. First of all, that's interesting, I would observe in itself, that often we end up in kind of American institutions, ex-British politicians. And second, there's a kind of tradition in these places, not just in economic policy, but in foreign policy and the like, of having, of a kind of producing people who are kind of equipped to participate in the public debate. And when it comes to the MPC, my observation was, once the Bank of England was given independence in 1997, they went through, under the Labour government, a series, all the kind of obvious individuals who were qualified in the sort of British economic establishment had their turn on the MPC. I came in and was able to appoint 3 or 4 people that Gordon Brown didn't like, and therefore had never been on the MPC. And then once we sort of got through all them, we started to have to look more and more abroad to people. I mean, of course, they're still very good domestic members of the, British members of the MPC, but we've increasingly had to look towards Americans to fill these posts, because the universities don't seem to be producing kind of macroeconomists who, with a sort of bigger view, rather than tend to be in a more narrow part of the profession. And I remember with Nick Macpherson, who you might want to talk to about this, because he sort of took the lead on it as the permanent secretary at the time, we did talk to a number of leaders of the sort of British academic community about what we could do to try and encourage more of a supply. But you're right that we've got to get the demand right as well.
I mean, George is completely right. We set out part of the purpose of the 4 independent members, as well as to sort of challenge groupthink and have that kind of open debate, was also to try and encourage more people to see that as something that they would do as part of their career. And it is frustrating that we haven't seen the kind of flow through that you might have hoped for. That's clearly the case on the MPC side. Is even more the case, isn't it, on the Financial Policy Committee side? And I would be surprised if most members of the committee could name the independent members of the FPC. I think I would struggle to so.
Very good. I'm just going to bring in Lord Griffiths, who wants to maybe pick up on some of these points about appointments.
Well, can I ask 2 questions, Mr. Chairman?
Please do.
Let me.
So long as they're quick.
They'll be quick. The first question is, one feels at present when one talks to people who are at the cold face today, there's a lot of uncertainty out there. So far, the crisis has been managed. On the other hand, there is a lot of uncertainty. To what extent do you think that the bank particularly has the macroeconomic prudential risks really kind of pinned down? Or to what extent do you think that in different parts of the system, which we, near banks, etc., there really is trouble? And secondly, I have to say, I've been very surprised today at the fact that you've almost defended the fact that there is no groupthink in what I'd call the monetary establishment. And I think you could make a strong case that there is a groupthink. And also, there are so many Treasury, I mean, all of the the 4 deputy governors of the Bank of England have got Treasury experience. And I just wonder, in the way appointments are made there, is there no way of opening up the system to have greater diversity? I think when it started, there was greater diversity, people like Charles Goodhart and so on. But it seems to me, as time has gone on, there has been less diversity. And I think in that sense, we do need something. We need a lever to open the whole system up a bit.
I think, well, I essentially, I hope you feel I agree with the spirit of that, because I have sort of gently suggested, without wanting to be rude to excellent current public officials, that, you know, the Bank of England should have more, shouldn't draw all of its deputy governors from the Treasury. I think, to be fair, 2 of them may have started their careers in the Treasury, but are not.
Didn't you appoint most of these?
I appointed some of them, yes. Not all of them.
Just checking.
Well, actually, I'm trying to remember. Only half of them I appointed. But someone like Ben Broadbent, you might say, Treasury, but he's not really he is someone he was a market. He was from Goldman Sachs. He brought a market perspective to the role he does. Sam Woods, yes, was a Treasury official originally, but he was then John Vickers's official on the Banking Commission, and so exited Treasury early on. And
I take that.
I think it's it's wrong to say they're all from the Treasury. And by the way, as I say, Dave Ramsden and John Clun have given the country great service and give the Bank of England great service. You're right that we want to try and encourage a bit more diversity, but there is a challenge of when you're sitting, when you sit there as Chancellor and it's like, who can you appoint to the MPC, and they produce the list, all the obvious candidates have already done it.
Mr. Balls, what do you think about that?
I think that you have to decide as a society, really, it's beyond the individual appointments, to try and encourage people to move between different realms. So if you decide, as America does, you have people who spend a period of time in academia and a period of time in the Treasury, then they go back to academia or to a think tank, and then they may go to the Federal Reserve. I mean, it's a normal thing for people to structure careers where they spend periods of time. Yes. That is much less common in our system, and it's quite hard to simply make that happen quickly. And as I said, with the MPC, we tried to encourage this more, and I don't think we fully succeeded. But there are very many more people in public life now who've been members of the MPC or have been involved in the making of economic policy today than was the case 25 years ago because of the MPC. And there was a period, I think, when the MPC, the individual members, were contributing less to public debate, which always potentially raises issues of groupthink. And it might be that in the period where there's a great focus on forward guidance, that slightly tends to corral people into one way of thinking. But you couldn't say in the last 9 months there's been groupthink in the MPC. So my desire is to try and encourage the same kind of debate on the financial policy side, where I think there is more groupthink, and there are structural reasons why that is the case at the moment. I mean, I would only note just
one specific question. It seems to me that the whole economic establishment in this country has taken over the new Keynesian model. And if you look at the bank, as a result, for very short-term forecasting, it's fine. But in the end, it has no real theory of inflation. was if you look at America, there is, on this point, there is much greater diversity about a new Keynesian approach to the whole thinking of macroeconomic policy. And it's that, to me, that is actually, in a way, the most difficult aspect of groupthink to come to terms with.
I guess my reply would be that in my first lecture at Harvard as a graduate student in 1988, I was taught by a guy called Greg Mankiw, a Republican who had a dog called Keynes and whose hero was Milton Friedman. And he explained to me that actually the right way to think about the economy was as a synthesis between important ideas from monetary theory and the historic antecedents of monetarism, which you see in the work of Friedman, but also Keynes' treatise of money in the 1930s, but also to think about the way imperfections in markets and imperfections in expectations can then drive inflationary processes, and that in the end there is a synthesis of Keynesianism and monetarism which we all employ and within which we debate and argue.
Can I say, Mr. Balls, I agree with you completely, and I would say I'm a pragmatic monetarist, but what I don't see is I don't see that diversity coming out of the central bank or the Treasury.
It's interesting. I mean, when you took evidence from Mr. Paul Tucker, who I work with at Harvard a lot and is obviously a great man, his main criticism of all these Treasury officials was that they hadn't spent enough time in the Bank of England, and that if only, and let's be honest, being a central banker is a profession, and you do want to have that depth of expertise, but there may be ways in which we can have in the Treasury and in the Bank of England people who spend time in and out, and we think of that in terms of people who want to be permanent secretaries who need to have time managing in the private sector. I remember my old friend Jeremy Hayward and his time in the financial system. But maybe that needs to be something we think about intellectually as well as in terms of practical management experience. I'm not sure whether being a 40-year lifer is the right qualification to make difficult decisions. But I also, let's be honest, I don't want somebody who has been a chartered accountant for 25 years and fancied a career change to do my cancer operation.
Mr. Osborne, do you have anything to add on this diversity of views?
No, I'm still getting over the dog's name.
Okay, thank you. Baroness Noakes.
Our inquiry is not looking at specific decisions that have been made by the bank, but inevitably the events of the last few weeks have raised some issues that are worth reflecting on. Mr. Osborne, you spoke earlier about SVB highlighting the fact that money moves very fast, and indeed Credit Suisse as well, and that smaller banks can be systemically important, though conventionally were not thought of before. Neither of those observations are actually very new. Is one of the conclusions that we draw that the FPC is not necessarily very good at understanding what's actually happening in the modern world?
I think that's a bit that's harsh on them. I think sometimes, if you take the Silicon Valley Bank, I think it's interesting because both the Federal Reserve and the FDIC sort of went out of its way to say we're not bailing out regional banks. And actually the Bank of England initially said that the SVB UK was not systemic, or words to that effect. And then it sort of emerged over a few days that in fact a whole kind of tech ecosystem depended on this, probably the most productive part of the economy depended on this particular bank. Now you could ask yourself how the world ended up in that situation. But I don't, I think it was been hard to see in advance, personally. But what was not hard to see in advance was that bank runs could happen very quickly. And I also think it was not hard to see in advance that Credit Suisse was clearly in a lot of trouble. And, I guess I don't know the answer, but how many conversations were going on between the Bank of England, the Swiss authorities and the US authorities. We did an interesting exercise, which I think is publicly known, but not had much attention, in where I did a role play as Chancellor with the Treasury Secretary, Mark Carney, who was then the Governor, the Chair of the Federal Reserve at the time, and we did a role play in Washington of what it was like, what would happen, and the various other US regulators. And we went at the sort of tail end of an IMF meeting when no one noticed. We went off and we did to the FDIC headquarters in Virginia, and we role played for 3 or 4 hours what would happen if a large US investment bank failed, which was code for about 3 or 4 household names. And we also did a role play of what happened if a large British international bank failed, which was code name for about 2 household names. And it was interesting. You managed to assemble all these very senior policymakers in the US and the UK to run through this scenario, which in my experience in government, I think it was pretty much, apart from the odd sort of military security role play we did, that was the only kind of thing where I did a kind of a sort of exercise, essentially. And we, what it was really designed from our point of view was to establish that in the end, the Federal Reserve would give us a dollar dollar swap, which was not entirely clear and hadn't been entirely clear in a previous crisis around Standard Chartered, where a New York State regulator had threatened to remove the dollar license from Standard Chartered, and then it wasn't clear whether the Federal Reserve would give us the dollar swap facility to bail out a bank that had been sort of singled out by a US regulator, albeit not at the federal level. So we ran through this kind of big exercise, and I thought that was really healthy and interesting. And I promise you, at the time, everyone was like, "What? We're all very busy people. Why are we being asked to do this?" But it was a really good exercise, and it actually built quite a lot of cooperation between the two teams, both the preparation of the exercise and the carrying out of it. And I would be interested to know whether that kind of thing still happens, whether they've done anything, whether the UK, US. Let's be honest, mostly it's going to involve a US leg. These problems. Is there any kind of role play or kind of scenario planning, particularly at the principal level? And if not, perhaps it should be encouraged.
Of course, Lord King and I went through 2 such role plays in 2006 and early 2007. A UK role play where a Northern Building Society got into trouble because of collateralised problems, which then infected a major clearing bank. And we learnt some important lessons, which
didn't stop the financial crisis.
Didn't stop the financial crisis.
Yes.
And then we had
if we'd had time to pass the legislation on a resolution scheme that came out of that exercise, then that would have meant the issue over Northern Rock would have been very straightforward to handle.
That's true.
The most interesting one on the US, when we did it, was that when we had a video conference,
That's right.
and it was the Chancellor, Governor and head of the FSA. At the American end, there were so many regulators, you couldn't see them all on the same screen.
But also, if you remember, Mervyn, they wouldn't go in the same room.
Yeah,
The Americans all had to be in their own institutions. So we were talking to each other across the 3. And the Americans, as I've written about, in our UK role play, the lifeboat in Christmas 2006 was ABN AMRO. Reflect upon that. It turned out to sink.
So what lessons, sorry, but Baroness Notes, you want to come back in on this. So what lessons we should learn from this, Mr. Balls, from these role plays? Should we be doing more of them? Is that
I would do more of them. Sorry.
You're fine.
I would do more of them, and I think there's, the Credit Suisse example is a good one. Everyone has known for some years that institution was in trouble. I think Andrew Bailey, as himself said, we had a plan. It's just we didn't know the Swiss weren't going to follow the plan. And I think, and you never, I think those are the hardest situations, because in the end, every jurisdiction will then look after what it perceives as its immediate short-term interests. But building a level of trust, I think both with the Swiss, the ECB, the Americans is really important, and confronting the reality that when you're dealing with the Americans, there are many different regulators. So who is going to be the people you'll, it's no good if you might know who the Treasury Secretary is, but if the Treasury Secretary says, "Sorry, I can't do anything about this regulator," then your plan doesn't work.
I'm going to bring in Baroness Kramer, because I think she was wanting to get into a lot of this in her question. But
well, I do. I don't know how much time we've got, and you've covered an awful lot of the ground. But it's this sort of whole international aspect to it. And from what you were saying, Mr. Osborne, that the regulators operate within a national jurisdiction. The markets don't. and crises don't. So I just if you had any additional thoughts on whether or not we could enhance cooperation internationally to deal with this sort of range of issues, and whether or not the FPC, for example, has the kind of mechanisms that are needed to pick up on crises which originate elsewhere. And I'm going to slightly beyond my question, because only 50% of finance now is outside of the banking world and is in what we politely call shadow banking. Adding to the complexity of regulation here. Can you give us some ideas, some thoughts on where we could go to try and deal with this changing world?
Well, it's a big question. I mean, so yes, I think the kind of international cooperation is important. And you can use a number of fora to do that, like the G7.
Can they move fast enough?
I think they can if they need to. What these situations most recently have proved is things can move incredibly quickly if they need to. The authorities can move incredibly quickly. But but also that whatever kind of rules you've established in advance, we're going to bail in these creditors. We're going to, can all be thrown out the window in a crisis. Truth be told, the US had told everyone their deposits weren't insured, and then, sure enough, insured their deposits, and that's going to have quite a lot of implications for the US banking system and indeed where people store their money in the world. So I think you have to be tolerant of the fact that however much you try and prescribe it in advance, in each crisis is unique. And in a crisis, national authorities will do what they regard as in their sort of supreme national interest at that moment. And you need to therefore not, always have that in mind, be realistic about that, and build the relationships both internally within your own system and externally with other regulators and governments in order to best prepare yourself for that situation.
I mean, it's always really important to use crises well. And if you go back to when I started, soon after Bank of England independence, around the time of, if you remember, the Thai Indonesian crisis and then LTCM, where it was actually the UK which first proposed that there should be a financial stability forum, and also that the IMF should report on financial risk at the meeting of the IMFC. There was huge opposition to that, mainly from our American colleagues who just didn't want there to be any collective discussion of these regulatory or financial risk issues. And the US has moved a long way over 25 years, and we often discover that not as far as we thought, and there were setbacks. But it feels as though, I think the question we need to be asking at the moment to the bank and the Treasury is what is happening now within those international fora to try to make sure the next time we have one of these crises is better than this one. But this one was better than the last one. So we are moving forward, but always imperfectly. And the truth is that recent weeks I think actually the Bank of England came out well out of the last couple of weeks, but for the Swiss financial system and for the US, this has been a knock.
Mm. Yes, well, I think there's something interesting there. Baroness Noakes has been very vocal on this as well, which is you talked about the rescue of Silicon Valley Bank UK, but we may have hold ring fencing below the waterline, or at the very least given a huge competitive advantage to HSBC. So it's not 100% perfection. So
if you've got money in a crisis, you're always in a good position.
Yes, you've got everybody over a barrel.
Excellent. Unless there's anything further, I'm going to bring in, I'm conscious of time, Lord Vergy, do you want to come in?
My original question has sort of been covered, I think, but I'd like to just go back to my point about accountability and what Lord Griffiths said about groupthink. And in a world where the world is so much more dynamic, moves so much faster, and again, as a man in the street or a woman in the street, it seems to me we've been thrashed. The system has been thrashed 6-0, 7-0. We're in a really bad situation. And yet we're sitting here and saying, well, nothing needs to change. And I'm like leaving this place.
Be a bit more optimistic. I would say we went through a financial crisis which had all the hallmarks of what happened in the 1920s and 1930s, and shocking as it was, in the sense of, it did not lead to the mass unemployment that we had seen in previous generations. We went through a pandemic, which for the first time in world history, we could actually pay people to stay at home rather than having forced work and infect everyone. And we could feed their families and manage that crisis. So, and by the way, we've just had a war in Eastern Europe, which has not spilled into a wider conflagration across Europe, and we've been able to support families through the winter, despite it involving one of our major energy suppliers. So, I would say there's lots of things that have gone wrong, but broadly speaking, these Western systems have handled very unusual crises, and I'm not saying we've had spectacular economic growth, or the opportunities have been what we'd all wish them to be, but nor have we had mass unemployment, or we've not done badly given some extraordinary situations. I'm trying to think of a better way to express it, but the systems have not done too badly.
Following on from that, we had a interesting discussion in the autumn about what was called Treasury orthodoxy. And it's an interesting question is, what is this Treasury orthodoxy? And there have been maybe periods in history where there was a orthodoxy of view, but the reality is that in the last 25 years, Treasury orthodoxy has supported chancellors who wanted to cut the top rate of tax and to increase it, and to increase tax credits and to reduce them, and to reduce capital gains tax and increase capital gains tax. Lots of different decisions, important economic and distributional decisions, to have regional development agencies or to back elected mayors. But the consensus of the last 25 years is to have an independent central bank and clear fiscal rules and independent forecasting, as has emerged through the NAO role we had, and then to the OBR, and proper respected budget processes. And what happened in the autumn was an attempt to rip up, in the name of challenging Treasury orthodoxy, that cross-party consensus about the right way to make economic policy. And it was a catastrophe, and it's ended up restoring that sensible way to make modern economic policy in an open economy like ours. And I think that is a very positive thing, and that's actually happened with public support. Now, you're completely right. In order to see off populist political pressures, it's also important that people feel that inflation comes down and their energy bills are supported, the economy grows, and all those things. And if we don't sort those wider things out, then our politics will continue to be challenged. But you can't lay all those wider economic and political objectives at the door of the Bank of England for precisely the reason Lord King says, which is to add too many secondary objectives to the institution you're examining in this inquiry. But the institution in this inquiry has been strengthened by a populist attempt to rip up the system, and actually the system has emerged stronger as a result.
Lord Davis, do you want to quickly go in?
Well, my question has just been answered.
Okay, thank you very much.
Positively or negatively?
Lord Griffiths.
I've got a question.
Lord Griffiths.
I'd like to ask one question about the court of the Bank of England. My sense is that the court has actually gone down in status. I was once a member of it, joined in 82. All the other 11 non-execs, Adrian Cadbury, John Baring, David Scholey. Eddie George brought on the agenda monetary policy for the first time since 1957 and the bank rate scandal. We met once a week on a Thursday from 12 till 1, followed by lunch. There was a very close relationship between the senior executives at the bank and outsiders, and they obviously talked a lot all the time, and there was a lot of advice given and so on. My sense today is that the experience of people who are on the court has really declined, and as a result the court plays a different function. And I just wonder whether it would be much more helpful to the governor and the deputy governors if there weren't more senior people there, more people who are running big companies and things, and had more experience than we have at present. I'd very much like to know what your view on that would be.
I did look at reform of the court on a couple of occasions, or rather proposals were put to me that we should create some kind of more like modern board structure, and I just thought, I'm not going to be the Chancellor who tears up the court after 300 years. That's a sort of depressing thing to do. I don't know whether, you see, I'm probably speaking beyond my knowledge here. I wonder whether the financial system and the private sector was different in the area you're talking about, that you would have sort of British-based institutions. These individuals would be prepared once a week, as you say, to come and give the governor the benefit of their views. And I wonder whether you'd be able to sort of assemble such a group in the modern financial services system today. And I also think, in some ways, the kind of Bank of England's intelligence and connection with the financial system has been more formalised through the PRA than was the case then. So, I don't think you necessarily need that. I think the court performs the function it does at the moment of, I guess, a bit of a sort of sounding board and a connection with the city, and then performing the kind of corporate functions of running a large institution. And remember, the Bank of England is subject to all the kind of pressures that any modern institution is around, workplace rights and equality and all that. And so, I think the court's trying to do that job. I don't know if it's the right institution to be the sounding board that it clearly was when you were on it.
Very good. Lord King, do you want to quickly?
You've both spoken eloquently about the importance of central bank independence. And when you said, George, about some people who put proposals to you, change court, I couldn't help thinking instinctively that the motives of those who were putting them forward were to try to get more Treasury control over the budgets of. And clearly, a key part of independence of an institution is it's having its own budget. And in the days that we were both involved in all this, the bank had a 5-year settlement. It was, Treasury were quite tough, and we had to justify what that 5-year settlement was. But it couldn't be changed quickly in the light of a particular problem that had come up, where challenging financial independence could be seen as part of a bargaining threat to influence policy. And I just wondered if either of you have a feel about the merits which have resulted from giving that away, essentially. It's now basically an annual settlement. You've got the Audit Commission now auditing the bank, which certainly when they came to speak to us about it, they were utterly incapable of auditing any complex financial operation, which was really what the bank was involved in. Do you think that where we are, where we've got to, is potentially a threat to independence because we've lost that longer-term financial settlement for the institution?
I don't honestly remember the kind of settlement for the Bank of England being a kind of issue that I spent a lot of time on. The general complaint in the Treasury was that the Bank of England officials were paid a lot more than the Treasury officials. And as a result, quite often people migrated from the Treasury to the bank for kind of pay and rations issues. I would instinctively agree with you. You'd want to, secure a long-term budget, try and make it independent of the government of the day, or not independent of the government of the day, but have some sort of security for it being regularly changed. I would do the same with the OBR. I would actually make the OBR a bit more distinct from the Treasury and separate it out from the Treasury, try and replicate some of the structures of the Bank of England. I sort of take you at your word in describing that there's a potential threat, but we've heard today how it's got £1 trillion on its balance sheet, so it can still afford to stock the wine cellar.
Can I just ask, sorry,
Profits all go to the Treasury.
can I ask just a very final quick question from me on deed of indemnity? Do you see any reason why that can't be published? We asked the Governor of the Bank of England, he said it could be. The government, in a written answer, seemed to say in December, they said publishing it would likely expose sensitive information. So we're getting very different views from the Treasury. And
I personally, I would not know why they couldn't publish it, but that doesn't mean they should. They should just perhaps elaborate on why they don't want to.
very good. I'm looking at my colleagues within here. We've covered a great deal of ground. Thank you very much. We were meant to go on for an hour and a half, but thanks to your excellent and informative questions. Yes, Mr. Balls.
To answer the question at the very end,
Yeah.
I've not been involved in bank finances for a long time. George, when I was Chancellor, and I spent rather more time on the household of the Crown finances rather than bank finances. But in my
That was
time,
very interesting.
all these issues, if I was ever concerned about these issues, I would have asked our extremely tough and public service-minded non-executive chair of court, Baroness Noakes, for her view, because I knew that she would know the right answer. And so that's what, if I was the committee, that's what I'd probably do this time.
Excellent. Thank you. Praise indeed. Thank you both very, very much. Very, very interesting session. We've covered a great deal of ground. You both raised some very interesting points, which we may come back to if you felt able to, just to flesh out just in writing, if you're able to and willing, for our inquiries. We're very keen to sort of offer up some practical thoughts on improvements that might be made. So getting views from you on those points is incredibly valuable. Thank you both very, very much. And with that, we'll end the session.